Equation in depth. We did the petty cash and bank rec, and we did the long-term assets. Last 2 weeks we've done the liabilities and time value of money. We've been throwing things over here periodically. Mainly it was in the cost of goods sold week when we had different type of revenues. We had sales return and sales discount. The last category is our owner's equity that we're going to look at today, this week. And then we're going to really kind of put things together next week by doing the statement of cash flows. It's the last financial statement. There's 4 of them. And we've done 3. We've done the income statement, statement of retained earnings, and balance sheet. And we're going to do the last one next week. But we're going to focus on the last area, owner's equity. If we were just doing a small mom and pop store, there wouldn't be any need to do owner's equity. Because there's just 2 accounts really. Maybe 3 if you have drawings. You have capital, drawings, and retained earnings if you wanted to use retained earnings. But if you have a corporation, owner's equity becomes a lot more complex. And there's a lot more accounts because you deal with stock. And that's what we're going to focus on today with stocks and a corporation. The first thing that I wanted to do with corporations is look at the setup of how a corporation is, the pros and cons. Okay, let's do the pros and cons first. I think that would be a good place to start. Generally, whatever's a pro for the corporation will be a con if you are a non-corporation or issuing debt. If you're trying just to be a regular company, not a corporation, and you want to issue notes or bonds instead of stock. One of the pros, and this one actually is, and we talked about this last week, one of the pros for both, if you issue bonds or if you issue stock and you're a big enough company, you're a public company, and you're going to be traded on the New York Stock Exchange or NASDAQ, you can get access to big money. Way more than if you're just taking out a loan from a bank. Now, if you're going to go public, you generally are going to be a bigger sized company because it takes money to do all this stuff. You can't just all of a sudden want to be a corporation and be traded on the stock exchange. You have to get approval, and it's just a lot of steps. Another pro, if you're a corporation and you want to raise money, is on your balance sheet, you have no debt. Because when you issue stock, what you're doing is you're giving up part ownership instead of giving up debt. So you don't have any liabilities on yours. You don't owe anybody any money. So another good thing here is there's no interest. There's no interest payments with stock. And along with that, there's no guarantee of dividends. The company doesn't have to pay dividends. Now, usually stock investors want the company to have dividends, and they may not stay with the company if they don't get their dividends, but the company doesn't have to provide dividends if they don't want to, or if they just don't have enough money to. That's a pro. Another pro, ownership's easily transferred. So if you become a corporation, and even a small company can be a corporation, you just won't be traded on the New York Stock Exchange. You'll hold all the stock yourself. But when I say ownership is easily transferred, that becomes a big deal, especially if you have like a partnership and there's quite a few partners, maybe 5 or even 2 even. If you have a partnership called Vineski and Addison, Paul's last name. And all of a sudden Paul wants to leave. It's no longer called that name. I'm going to have to dissolve that company legally and start up my own new company on myself or with another partner. And it just becomes more messy than if you're a corporation. You just simply sell your stock to whoever company somebody wants to buy it. And that's all you need to do. Or like if you have a partnership and somebody dies, then you have to dissolve the partnership and start up a whole new one. It can become kind of messy. Why not a corporation? Some of the cons. There's lots of government regulation. And that's good to a point. It's there to protect the investors who invest in public companies. They don't want people to invest their money and then get ripped off. It still happens, but when you have a lot more regulations with the government, not nearly as much. But that's a con. You have a lot of paperwork and a lot of rules you got to follow. That's not so good, necessarily. Double tax is a big one. Double tax, and what I mean by that. Corporations are taxed not only on their net income, but also when the owners receive it, when the owners receive the dividends. So if you're an owner of the corporation, your corporation that you own is losing money by paying taxes on the net income, and you're being taxed again when you receive your share of dividends. If the company pays dividends, you're being taxed again at your level. So you're kind of losing out twice. You lose out when your company, your corporation that you own some of, is taxed up front, and then you're taxed again when you receive your share. So that's a big con. For if in comparison though to a partnership or your own sole proprietorship, you're not taxed at this level. Individual companies, if you do, like in our tax class, if you have a Schedule C, you don't have an income tax. You just pay tax at your own level, at your own personal level. You're just taxed on whatever rate you're at, kind of like getting a dividend. You're just taxed on your overall income, net income. And then the company doesn't have a separate tax that they pay the government in a Schedule C or a partnership. You're just taxed one time, but when it's a corporation, you're taxed twice, potentially. Now there are a few things that could be different, but it's not too much. One of the big ones, con, is loss of ownership. Ownership. Instead of giving up liabilities and having to pay it back, you're giving up part of the company. Therefore, you don't own all of it. You have to share. You're no longer the sole person in charge. That could be big. And the other one, the last one that I would mention here, is management. And owners are usually different. Just because you're an owner, these guys don't usually equal. Management isn't necessarily the owners. When it's a sole proprietor, if you own it, you're the head manager too. They go together. But when it's a corporation, if you go out and buy Walmart stock, you don't all of a sudden start making Walmart decisions as management. You can own part of Walmart, but that doesn't mean you're part of the management in the same way, other way. If you're one of the CFOs, that doesn't necessarily mean you're an owner. All right, let's talk about now setting up a corporation. First thing you have to do is develop what's called the Articles of incorporation. These are a set of very broad guidelines on how your business is going to function. And they're going to include some broad things like the company name. You have to file these. You file these with your home state. Now, your home state doesn't necessarily have to be where all of your main offices are. Does anybody know what state probably has the most corporations designated as its home state, even though the corporations don't have their main headquarters there?
I know something like it's like around Rhode Island or.
Yep, you're getting close.
New York.
Not Maine? No.
New York.
Delaware.
Delaware.
Delaware is where a lot of companies set up because they have very favorable corporation tax laws. I don't know extensively, so I wouldn't be able to speak on that. But I just know that's where, even though a company is maybe headquartered in Indiana, they may say, I want to set up shop in Delaware, and then as long as you meet a few guidelines, maybe you rent out an office, and so you have some space there. That may be all it takes. I don't know all the rules because I don't have a corporation, and I've never had to set one up. But you have to meet just a few guidelines, and you can set up with whatever state seems best for you and your company. And a lot of people do Delaware. So in your articles of incorporation, you're going to have some of the bare bones of your company. Company name, where it's located, your headquarters. What's your purpose? Why is the company even in existence? Meaning, what do you make? How do you plan on making money? And you're going to list your board of directors. That gets me to, when I say the board of directors, the corporations have their own little hierarchy that you definitely need to understand. The top dog in a corporation is always whoever owns it. And the owners are the stockholders. So if you go out and buy stock, you become a part owner. The owners, but remember what I said before, owners and management aren't the same. What the owners do, since these guys usually are the ones with money, but they may not have time to run every company that they own, so what they do is they hire the board of directors. The board of directors, these guys make the big decisions. Board of directors, they make the big decisions on where the company's going to be located, what the mission statement's going to be, all those, whatever. And they look at broad things, not necessarily the day-to-day activities. The board of directors then hire the people that do more of the day-to-day operations and exactly how the process is going to work to make the best decisions. And these guys are your CEO and the CFO, the main guys in charge, who basically are the face of the business and run it. And then they delegate, keep going down, upper management to middle management, all the way down to run the day-to-day operations. So when you're setting up, you're going to list, because it's very important, because board of directors are a big integral part of any company. And then look, one of the other things you're going to list, this isn't an all-inclusive list, but one of the things you're going to list here is what kind of stock you're going to have and how much. How much are you going to authorize? And there's a reason why. You don't want to have and tell everybody I have 100 shares and then Rebecca wants to be a half owner, so she buys 50 of mine. And then I decide, nah, I don't want Rebecca as a half owner, so I just make up another 100 shares. So now there's 200. So now all of a sudden she's only a quarter owner instead of half. Well, that wouldn't, I don't think she'd like that very much. So it would be stated here that this is how much stock we have. If you buy half of it, then you have half. I can't just go make more. And so with that stock, that leads us into the two different types of stock that are available, that the companies have. Types of stock. Common versus the preferred stock. Preferred doesn't necessarily mean it's better, but you'll see why it's preferred, why it's called preferred in a second. Your common stock is the default. If you only have to have one type. If you only have one type, it's this one. This is the ownership stock. Whoever has this type of stock is part of the ownership circle. These guys over here aren't investors in that way. They don't have the ownership, the voting rights, unless it's specifically stated. Now, every company can do a little different. They can say our preferred stock, they say it in the articles over here, our preferred stock has voting rights, but by default, common stock is your ownership. These guys also have the ultimate risk / reward. If the company does really well, the common stockholders will come out ahead. If the company does bad, the preferred stockholders generally come out ahead. And you'll see how that plays out here in a little bit. Ultimate risk and reward, and usually that's based on dividends that are issued, the dividends being received, or liquidation of the company. If the company ever has to go bankrupt, if there's a lot of the company to give out, the common stockholders will usually come out ahead. But the other way, the preferred, if it's not so much. And the last thing I'll put here, common stock, is, I lost my train of thought. Oh, yeah. Like I said before, on one of the pros and cons here, no guarantee of dividends. Just because you own stock, common stock, doesn't mean the company's going to be paying you dividends. We should take a step back. What exactly is dividends?
A loan.
Huh?
A loan.
No, it's not a loan.
Oh, it's a loan.
Yeah, it's bonds. I don't want to keep using a word when we don't exactly. What are dividends and where do they come from?
Isn't that a sum of money that gets taken out of, like, big capital gains to the owners?
I don't like the word capital gains. Trent?
Would it be like the net profit of the company?
Oh.
Yeah. So if a company has, remember what revenues minus expenses equal our net income, and then let's say we have a $10,000 net income, well, that's the owner's money. And what are you going to do with that $10,000? You divvy it up between all of your stockholders, and you give them part of that $10,000 each. But some companies say, I don't want to give out all $10,000 because it may not be wise. You may want to invest in the company, keep some money back to have to buy new stuff. So maybe they only give out $5,000. And so that 5,000 that the company earned, that needs to go, that's left over, that needs to go out to the owners. The owners invested and they should see a return on their investment. But again, if the company does poorly, there definitely wouldn't be any dividends necessarily. With preferred stock, these guys over here get first dibs on dividends. But it's a set amount by default. So maybe these guys, if there's a dividend given, these guys automatically, no matter how much is given, they get $5 a share. And maybe that only leaves 50 cents a share for these guys left. That's why this one's called the preferred stock, because they get their dividends first. But it's usually a set number. And then all the rest, if it's a whole bunch, ultimate risk, ultimate reward, goes to the common stockholders. So if there's a big dividend given out, the preferred stockholders only get 5, but maybe these guys got $25 a share. So even though they got it first, it wasn't necessarily better. And then how dividends are stated is on your stock. You take a percent. What you do is you take a percent of the par value. And this is where we need to discuss a little bit of what par value even means. Par value is basically the lowest that stock can be issued for. When a company sells it, they'll have a par value. For most common stock, it's really low. Most companies set it at like $1, and you'll see that in our examples. For preferred stock, it's usually a lot higher. It's maybe $100. So to get a stock, it's going to be at a minimum of 100 to buy it, and it may be more. And then there'll be a percent in front of that, maybe 10% of $100 par. What that tells you then is 10% of the par you get as a dividend per share. So $10, every time there's a dividend given out, for every share you own, if it's 10% of 100, you get $10. That's what that means when we see that in some examples. Last thing before we actually start looking at issuing stock is a stock's life. What phases can a stock go through during its life? There's 5 stages. The first is just when the company sets up their articles of incorporation and they authorize the stock. It's out there, it's ready to be sold, but it's still just, it's waiting. It hasn't been sold yet. Issued. That means it's been sold. It's been sold. The stock's been sold. The third one is, the third and the fourth one are opposite of each other. The third one is outstanding, meaning it's been sold, it's been issued, and it's still in public hands. It's still out there. Oops. By contrast, the other way is the stock has been sold, it's been issued, but it's been reacquired by the company. Meaning we bought it back. Treasury stock is still listed as being issued. I still have issued it. It's just that I have temporarily bought it back for whatever reason. There could be lots of reasons why a company might buy back their own stock. Maybe they think the stock is too low in value. Well, if you buy it back, it's just kind of like simple economics. More or less supply means more demand, so your price is probably going to go up on your stock. Or maybe they don't, there's too much of it out there and they don't want to give up that much ownership, so they want to buy some of it back so nobody has a really controlling interest in it, in the company. There could be different reasons why a company buys back their stock. And then the last phase, so a company could buy back their stock and then actually resell it so it becomes outstanding. But if they decide to buy it back and then never issue it again, it's called retired. And then at that point it's no longer issued or even authorized. It can no longer be sold ever. The number of authorized shares would go down once you've retired it. Any comments so far about corporations and setting them up? And
The treasury part where you said things can be acquired by the company or reacquired.
yeah,
Number 4,
yeah.
Um,
The treasury stock, what about it?
is that reacquired?
Yeah, reacquired.
Okay,
Sorry, yeah, reacquired.
thank you.
All right, let's look at what a company does when they actually issue stock. Let's look at number 46. And you'll want to have a separate sheet to do some T accounts. Now, I wouldn't use your actual T account sheet that I provided a long time ago, because this one we're only going to look at the owner's equity part. Okay, so over here, I'm just going to keep track of the owner's equity, just for our purposes today. I'm not going to do all the other T accounts, because the owner's equity will be enough. And you'll see why I keep track of it in a little bit when we do the financial part. All right, so December 1, I sell, this is how it would be worded, 10 shares of stock, $1 par, and it's going to be common stock, and they sell for $10 each. So a couple of the key things here, definitely I need to know the par value, and you'll see why. And then I'm selling common stock. So just like any other debit question, what do you ask? You're unsure what the debit will be.
What did we get?
Yep, what the company gets. So if I sell stock and I'm the company selling the stock, yep, I got cash, good. I got cash of how much?
$100.
Yeah, $100. I sold 10 for $10 each. Now, note that this is different than, this is me selling my stock and not me like buying somebody else's stock. A corporation could buy somebody else's stock. This is me selling our own shares. So this is owners giving us money. Just like before, if an owner, this is what it would have looked like before, don't write this down. But if an owner would have given me money, I would have said cash and credited the capital. Right? They invest money into the business. That's what we're going to do, something similar here. But instead of calling it capital, because it's not an individual business, we call this first item common stock. And common stock is always valued at par. You always put your common stock at the bare bones price, what the lowest you possibly could have issued it for. And that would have been a total of $10. 10 shares at $1 a piece. So people gave me money because they're gonna become part owners in the business. The rest of the money goes into an account called additional paid in capital. And then kind of like with accumulated depreciation, you put what it's for after it, like equipment or vehicle. Additional paid in capital, common stock. Again, that's additional paid in capital. APIC is usually what you'll see it abbreviated as.
And all these accounts are under owner's equity.
Yep, everything that we're gonna be doing, I'm not gonna be doing anything else. Everything's gonna be under owner's equity. Yep, so it's gonna be, I'm really expanding it for our purposes today. On the third, we're gonna see that we don't necessarily have to get cash in order to give somebody part ownership. On the third here, we got equipment instead of cash. So that's gonna be our debit. Equipment, you put it down at what the equipment would have been valued at. What would you have paid for it with cash? Somebody would have paid us, or we would have paid $200. So somebody's investing in our business, and in exchange, I give them part ownership. 20 shares at $1 a piece. Remember, once you have the par set, that would be something in your articles of incorporation. That's not going to be changed. So once the par's set, it's set. My additional paid in capital is the rest. Right now, we don't necessarily have to get cash, we don't necessarily have to get equipment, some sort of asset. Maybe we're paying off an expense, so my lawyers have done work for me, I just don't have the upfront money to pay them, but in exchange they decide to take part ownership in our business, which very well could happen. So here we decide, okay, what was our total legal fees, so legal expense. And I give them common stock, 30 shares at $1 a piece. Now, on the 5th, we decide to issue our other type of stock. We're tired of giving out ownership, but we still want to raise some money. So we're going to go ahead and offer some of our preferred stock. These guys are really only in it to get the dividends, so unless I plan on giving dividends, they probably won't buy it. So I've issued 10 shares, and remember what this was, 10% of $50 par. Which I'm going to have to use later. When I'm giving out dividends, that's when that's going to become important. These guys are guaranteed, well, if dividends are given out, they're going to get $5 a share in dividends. So I'll have to remember that and come back to it. But I sold these 10 shares, so what did the company get? Cash. 10 shares at $75 each. And in exchange for the money, they're going to get some stock, and that stock is valued at $50 par. So 50 times the 10 shares, and the rest goes into preferred stock, additional paid-in capital. All right, now the 6th, we decide to buy back some shares of our own stock. Now this is buying back our own shares. This isn't going out and, if we're Walmart, buying Target shares. If I go out and buy Target shares, I would count that as an asset. I own, as an investment, part of Target. But if I buy back my own shares, you can't invest in yourself. If I buy back my own shares, that's called treasury stock. That 4th phase. I usually will abbreviate it TS from here on out. Treasury stock is a contra account. It's people taking, it's people giving back stock. They're no longer owners anymore. So that's why it's a contra. And I bought back 5 shares at 15 each. I would have had to pay those owners cash. Off to the side somewhere, I like to keep a little inventory listing of my treasury stock. Because when I resell it, just like when I sell inventory, I want to get it off my books at what I bought it for. Same thing with treasury. Like with inventory, if I buy something for 4, but I sold it for 10, I don't get it off my books at 10. I get it off my books at what I paid for it, $4. Same thing here. I bought 5 shares at $15 each. So that's a total of 75 in my treasury stock little side listing. Now that's going to come into play when we start reselling some of my treasury stock. Okay, on the 10th, I resell 3 of the 5 shares for 20 bucks each. That's pretty good. I bought it for 15 and I'm selling it for 20. If that would have been anything else, if I would have bought Target shares like that, I would have said I had a gain. I brought in more money than it was on my books for. But when it's your own self, you can't call it a gain. You can't have a gain in yourself. But if I resell these shares, what am I getting? Cash. I'm getting $60. Why did I get the cash?
Because you're still in treasury
Yep.
stock, so you have to credit it for
Good.
45.
Very good. Credit my treasury stock. I go back up here and I have to get rid of 3 shares at the 15, so that's getting rid of $45 worth, leaving me 2 shares left on my inventory listing here of the treasury. So I credit my treasury stock for 45. My last account is additional paid-in capital. This is like a gain. It's treated very similar to a gain, but we just don't call it a gain. If it was in another corporation, we would set a gain here, but not when it's in ourself. Now, let's, I didn't add this in here, and in the future I probably will. Just add a little note in here somewhere, maybe at the bottom. Put that the company, let's say the company had net income of, let's say they had net income of $400. Because you're probably not going to pay out dividends unless you have net income. So we need to have some kind of an income.
Is the additional paid for the treasury stock, is that a contra account?
No, good. I forgot to put that up here. Additional paid in capital is a regular. Additional paid in capital treasury stock is regular. Net income. What composes of net income? The 2 big categories. What minus what? Gives you net-
Sales.
Okay, revenue and expenses. What happens to revenue and expenses at the end of the year?
They go away.
They go away. And where do they go away to?
Your retainer.
Retained earnings. So this $400, if we just pretend that we wouldn't even have to have this, but let's pretend that 400 came from something like this. Total revenues and our total expenses gave us the $400. If we close this out, that's going to leave us, we had 700 in revenue, 300 in expenses that we had to close. So there's the $400, whatever is in our net income, will end up here in retained earnings. So my retained earnings has $400 in it with this net income. And with that income, I decide I can issue a dividend, and I'm going to issue a part of that 400 as a dividend. And typically, when we issue a drawing, remember drawing's the same kind of thing. If you had your own business in the widgets, and you said the owner took out money of $150, what would have been your debit? And what would have been your credit? Owner withdrew $100.
Would have been, your debit would have been either like dividends or drawings,
Yep.
and your credit would have been cash.
Yeah, same thing here. The only difference is right now we haven't paid the dividends. All we've done is declare them. Usually what happens is a board of directors or somebody like that will get together and they'll say, okay, we're going to declare dividends at this date. So whoever holds stock on November 30th gets dividends. And then we'll pay them out at such and such date, maybe a month later, once we've gathered all that information. So on this date, we haven't paid it out yet, but we still have declared it. That means we are going to issue them. So we debit our dividends. Remember, dividends is a contra. And instead of crediting cash, I'm going to credit dividends payable. And I'm going to pay my common stock, and I'm going to pay my preferred stock. We just have to decide who gets what. Who gets paid first?
First one.
Preferred, and how much do they get paid?
The par,
What?
par value, percentage of the par value.
Yeah, so how much? Exactly. Go back up a little bit.
Be $5, wouldn't it?
$5. Yeah, they get paid $5 a share. How many shares do we have outstanding of preferred stock? Because you only pay dividends on those that are still outstanding.
10.
10, yeah, we don't, the treasury that we bought back, that was common stock. So we didn't buy back any preferred. So all 10 shares are still out there. So of the 10 shares, and they get paid $5 each, I'm going to be paying my preferred stockholders $50. The rest goes to common stock. So your first inclination may be common stock did better. Not necessarily. If you own a share of common stock, how much money would I be giving you? Think about it for a second. What do you see? What do you think your answer would be? If you own one share of common stock, how much would I pay you, given that I'm paying out $100 to all my common stockholders? Yeah, go ahead.
Is it $2 or do you have a total of 30 on stock?
Well, give me one answer first. Don't give me
Well,
two.
no, I meant like, is it $2 saying that you have? Oh wait, never mind. I did my math wrong. Never mind.
Well, what you do is you just take you're on the right track. You're right. You did the math wrong. You take $100, divide it by how many shares are outstanding. Well, since these are only $1 a piece, that we can easily calculate it. 10 shares, 20 shares, 30 shares. So that's a total of 60 shares. But how many are actually outstanding? I don't want to use 60. How many are still in the public hands? Not all 60 are out in the public hands.
Is it 30?
Nope,
55, they're out.
not 55.
45.
No. Look, how many shares of treasury stock do I still have back?
57.
How many shares of treasury stock do I still have at the company?
40.
2. So it's not 60 that are out
Or
there.
50.
It's only 58. That I have 58 shares. I had 60 at one time. Then I bought some back, 5. And I still have 2 of them left. So it was 50. It was 60. It went to 55. I resold 3 of them, so now I'm up to 58 shares out amongst the public. So per share, they're only getting $1 some. What is it? How can I do this? $1.72. Compared to what did my preferred stockholders get per share? $5 a share. So the common stockholders had to split it among a lot more people. Okay, let's do the last step now. We're going to prepare the balance sheet section, or the owner's equity section of the balance sheet. Again, we're only gonna do a partial balance sheet. We're not gonna look at the assets or the liabilities. We're just gonna look at the balance sheet part. So we've got company name, balance sheet, but it's just a piece of it. It's just partial. And the date, December 31, whatever the year is. Again, we would have already done the assets and the liabilities. We're on to the owner's equity part. The first category, if you're doing a corporation style, is called capital stock. And then we list the two types that we have. And what I also want to list here is how many shares are currently outstanding. I want to put here 58 outstanding. I would also list the $1 par as kind of a little bit of extra information in there. If I knew how many we had authorized, I didn't tell us that in the problem, I would put that in there too. But my common stock, $58. No, sorry, 60. I don't know, 50, oh, that was our, I got 58 outstanding, sorry, 60 issued is what I wanted to put here above that. 60 issued. And my T account says 60 as our value. Preferred stock, 10 issued and outstanding, I'll just put OS, $50 par. Then usually you have a total section, total capital stock. Kind of like subtotal and total, just like on the income statement or the balance sheet or the assets.
How come we don't put the treasury stock on there?
Oh, we're not done yet.
Oh, okay. Sorry, getting a little ahead.
Additional paid in capital section now. We had some for common stock, we had some for preferred stock, and we had some for treasury stock. So I've taken care of this, I've taken care of this. Now we're going to do these guys. Add it up, 17, 24, 640. Preferred stock, 250. Treasury stock, 15. Next is your retained earnings. Now I have retained earnings because of the net income of 400, but there's one more thing that goes into retained earnings besides just your revenue and expenses. What's the last thing? R, revenue, expenses, E. What's that third one?
Dividends.
Yeah, dividends, R-E-D, remember red. This guy doesn't go on our balance sheet. This guy would have gotten closed to retained earnings. On the statement of retained earnings, remember, it gets closed way back to week 5. So my retained earnings has a final balance, I know it's hard to see, but $250. Because that dividends gets closed. Just like my revenues did and my expenses did. To end up here. So my retained earnings is at $250. Pretty much got everything done now. The only thing missing is this one. Less treasury stock. Treasury stock, we want to list on here that I have what I have left. 2 shares at $15 each. Total stockholders' equity, or owner's equity, if you want to call it owner's equity or stockholders' equity, same thing. Gotta add all this up. Somebody tell me what that is when they get it.
I got 1685.
1685?
Yeah.
$1,865 plus 220. Yep. 1685. Let's see how well we've got this, and let's look at 47 and 48. They go together. You need 48 to finish 47. This is your opening balances. So this is not a brand new company. It's kind of new because there's not very much that's gone on yet. But I've given you all of the particulars so far. I tell you how much preferred stock is available total. Par value, 5%. So they're going to get $5 a share, 5% of the par. Cumulative, we'll talk about that, what that means, probably by Thursday. We have none issued, so that's why it's big 0 over here. Common stock, we have 1,000 that have been issued at $1 par, so that's how I got the $1,000. So when I'm doing my T accounts, I've got to put that. That's my starting balance. I can't just ignore that. I have $1,000 just like this was my opening trial balance. And I come down here to see what the additional paid-in capital is. Get that started. If my additional paid-in capital is this, and this is what the common stock sold, I sold 1,000 shares at $1 par. How much did I sell the shares for a piece? $10. Yeah. If I had $10 stock, 1,000 of it $1 par went to this. The rest of the $9 went here. My next item, this is just a total category, retained earnings. I started the year with $10,000 in retained earnings. So I have all the figures I need now to start doing this year's transactions. Now I can go into January 1 and start adding to this. So do the first two, and then we'll check your answers. Add them to your T accounts. Do the journal part. It should have been pretty good review from what we just did. There wasn't much difference. Does Toys R Us have a pretty high markup on all their goods? It seemed like there's.
No. We have certain items that are only Toys R Us brand, like Home Depot. Their toys, we are our brand, and those we have like a really big margin on them. As far as electronics, majority of our margin on that is next to nothing. We make hardly any money on any game system. We make money on the games and the accessories. That's about it. We try to carry a lot of like those, like Toys R Us exclusive brands, whether we do anything else.
Yeah.
But on certain items,
I know this is off topic of what we're doing, but one thing is I went into Toys R Us because my son, he's 6, and he really likes Minecraft.
yeah, that stuff.
And Minecraft, it's just a little teeny tiny foam little
They're
thing, and it's
$15.
$15. I was like,
But they're that everywhere. And
I know, and I don't understand that.
It's, well, there's only one guy that owns it, that like has all the rights to it. And so there's not, he can charge pretty much whatever he wants on it. And we, on that kind of stuff, we can't even make prices like Disney. We don't make our price on that. It's all Disney price, but the Frozen stuff, we sell on it every week we get it. It's insane. I don't understand it. But I know I get Let It Go stuck in my head at least like.
Oh, yeah.
Walking down the street just listening, because we play it every 5 minutes.
That's terrible.
Because I was also looking at for our 6-year-old one of those little cars that 5 mile an hour, and those are so expensive.
We have some, that, like,
$400.
we have some that we actually mark down closer to season, like closer to the holidays, and they actually end up being a decent deal compared to other places, but during the off season, they're pretty crazy.
All right, so you should be about to the third one. And the company's buying back stock. Treasury stock. $1,200 worth. And I would have a little inventory sheet that says, so I can when I go to resell them. We'll do one more and then we'll finish this on Thursday and do one more practice just like this to make sure you really got it. And then look at quite a few Wiley Plus ones. Because we'll still have, we're gonna talk about on Thursday, earnings per share, what that means. Hopefully you, at some point in your life, have heard of EPS or earnings per share. And then dividends per share. And we're gonna talk about stock splits, what that means. If you're an investor, if you have company stock and it splits.
Will we go over anything like, I was always wondering why the guy from Wall Street, like what he did was illegal. Will we ever go anything like that?
Which guy?
Jordan Belfort. I mean, it's kind of new. I was just curious if we're gonna go over something like that. I know like it was frowned upon a lot of this stuff, but I don't know.
Well, not in something like this class, we go over the basics on how to
Yeah.
do the stocks, and then
Yeah.
that would be more of an advanced, like case problem situation. or once you understand the basics, then you can talk
Yeah.
about what happened and why.
Yeah.
So on this next one, if we resell the stock for $55, like before, that would be considered a gain. And what we call a gain is additional paid-in capital for the treasury. I resold 100 shares, and they cost me 53. So I got rid of 5,300. So I'm down to 300 shares. I brought in 5,500, but they only cost me 5,300. So I made just a little bit of money. And that's gonna be come into play once we resell a little bit more stock, and you'll see what I mean when we start up on this. We'll start up on this first thing Thursday, so have this out ready to go with your T accounts.